Good evening. Thank you for tuning in. Principal Speaker, Dr. Terence Farrell, is former Deputy Governor of the Central Bank of Trinidad and Tobago and former head of the Economic Advisory Development Board.
I want to start very quickly with discussing the geopolitical and geoeconomic uncertainties which the world at this point in time is facing. We have the war situation in Ukraine, which is, as we know, is not just about a war between Russia and Ukraine. It is a fundamental geopolitical conflict between NATO and the West, and between an emerging axis, it seems to me, between Russia, China, possibly the Saudi Arabia and the Arab countries. The second issue, of course, has to do with on monetary policy. We know that there's talk about an impending recession or the possibility of recession. Interest rates have gone up very sharply over the course of the last 6 months and are projected to go up again during the course of 2023, which has had implications for the domestic economy. We know that a number of companies here in the insurance sector, in the banking sector, which have been holding assets overseas, including the HSF, have experienced a significant decline in the value of those assets as a result of the sharp increases in interest rates over the course of the last 6 months or so. We have the issue, which is now the enduring issue of climate change and how that is going to impact the energy sector going forward. There is the COVID-19 overhang. What's happening in China? China has changed its policy 180 degrees in terms of how it is dealing with COVID-19. It has reopened the economy completely. And so we'll have to see how that is going to play out. And as I mentioned, the emerging China, Russia, Middle East axis, how that is going to gain traction. And I pose these as questions, not as issues that I want to have answers to at this point, but certainly they are important because they have, in some cases, immediate implications for Trinidad and Tobago. But let me then turn to very quickly to what has happened over the course of the last year or so in respect of Trinidad and Tobago. In respect of the energy sector, basically, I'm telling people here who've tuned in that we know what has happened, basically, that in terms of production, that is the output in respect of crude oil, in respect of LNG, in respect of natural gas, that basically it has been flat. And, you know, so if you look at the charts, if you look at the numbers, that has been the case during most of 2022. And we'll have a look at 2023 a little bit later on. In the case of ammonia and urea, pretty much the same thing, in the sense that ammonia, urea, and methanol production has been actually below capacity for the petrochemical sector. But what is significant, of course, is that prices have increased. Now, prices increased significantly, we know, because of the conflict in Ukraine. So that we saw oil prices spike, we saw natural gas prices spike, particularly in markets in Europe. The European gas prices have just been, quite frankly, out of sight. Japan, even Japan, the Asian market for natural gas has been pretty strong. And even ammonia, we saw ammonia prices get to over, I think it's about 1,500 metric ton towards the middle of last year. It has since come down, and we expect that it's going to continue to come down. We'll talk a little bit more about that later on, but we have never seen spikes like that in ammonia. Typically, over the course of the last 10 to 12 years, ammonia prices have ranged from maybe 200 to about 700 at the most. The average price has been around 400. Similarly for methanol. So those kinds of numbers were really quite significant, those jumps. So basically the story here is production has been basically essentially flat, but prices were extremely high. There was a surge in prices, and that's, of course, the result of that, a tremendous increase in revenue for the companies, tremendous increase in the value of exports, and therefore a tremendous increase in government revenues. And so we can see that in respect of government fiscal operations, the surge in prices of oil, natural gas, and methanol leading to a sharp increase, an unplanned increase in government revenue. Government did not plan for, obviously, they didn't plan or forecast the war or the effects of the war, but it tremendously boosted government's coffers in I say, an unplanned fashion, as a result of which the numbers indicate, they've announced that there was, in fact, a surplus the overall fiscal operations account for fiscal 2022. The official number which we had earlier was showing a small deficit, of about I think 1% of GDP, but they're now saying there was in fact a surplus. The debt to GDP ratio has declined because GDP in current prices has gone up quite sharply with the increase in prices across the board. We've had, and I've talked about it before, an increase in interest rates rising very sharply, reducing bond prices. And so bond prices fell, but equity markets also declined. The S&P, the Dow, the NASDAQ, everything basically collapsed during the course of 2022 as a result of the Ukraine war and the various kinds of uncertainties that we saw. And the HSF is reported to have lost significant value in 2022. Not only the HSF, I'm saying, but also private companies in the insurance sector, in the banking sector, experienced a sharp increase in unrealized losses in respect of their investment portfolios. So, but if you look back, just going back over the last couple of years, what we see is that fiscal adjustment in this country has been dictated more by exogenous shocks than by policy adjustment. So that the fall in oil and gas prices in 2016, 2017, the COVID shock in 2019, 2020, and then the Ukraine war have been the driving factors in terms of the outturn in respect of government fiscal operations. In respect of prices and wages, we know that food prices began to rise during the COVID lockdowns because there was disruptions of the supply chain, higher shipping and transportation costs. Those costs have now begun to come down quite sharply, in fact, and they're getting back to normal from what I understand from talking to folks in the private sector. So although in overall inflation remained relatively subdued, what we have seen is that core and headline inflation beginning to accelerate from late 2021, led by higher food prices, and that acceleration has continued into 2022. So the year-on-year food price inflation as at September, because that's the latest number which apparently the central bank and the CSO have available, was 11.6%, which is a pretty sharp increase. And that's pulling up headline inflation, is also pulling up core inflation. So the big question for 2023 is, does that continue? And we'll have to look at that in relation to what is happening in the global economy and the implications of that for continued increases in prices. In respect of wages, as we know, the data that we have on wages are pretty bad. They're very outdated. It's very hard to get a fix on what is going on in the labor market. The numbers, from my perspective, are not particularly trustworthy in terms of understanding what is really going on in the labor market in Trinidad. Particularly, there are certain kinds of things that we would like to know, certain measures that we need to have, which we don't have. For example, data on underemployment and data on hours worked and so on across sectors. But it appears from the data that we have that real wages have declined over the course of the last few years. And I think that what we are seeing in terms of the reaction of the trade union movement to higher prices and so on is evidence of that. In respect of the external accounts and the foreign exchange reserves, although we had a tremendous increase in export earnings, we also had apparently a matching increase in imports and in capital outflows. So that the reserves number, because as you know, the reserves number summarizes the whole of the balance of payments. The current account and the capital and financial account is summarized by the movement in international reserves. Those didn't change very much between December 2021 and December 22. So what does that mean? So that although we had a significant increase in inflows coming in as a result of higher gas and oil prices, we also had a significant outflow of foreign exchange, which clearly, to my mind, because we don't have the data, we haven't seen the balance of payments across 2022, but we know that the merchandise account would have been in significant surplus. We know that the current account very likely was in significant surplus, and therefore the outflows that would have taken place would have been on capital and financial account. What are the elements of that, and how much of that is capital flight? We know the net errors on emissions number has been extremely large over the course of the last many years. In some cases, the net errors on emissions number is bigger than the current account surplus number that we are showing. And so therefore something is clearly amiss in terms of capturing the data on our external accounts, which needs to be understood. But we are also saying that the demand for foreign exchange, we know, has been suppressed over the course of the last several years. We've maintained what the IMF euphemistically calls a stable rate regime. But we've done that, and we've accomplished that by essentially suppressing demand. The banks sell to the public what is available for them to sell, plus what injections the central bank puts in, and the central bank has put in religiously, except for a couple of quarters where it has deviated from the 100 million US that it has put into the system every month. So the system has had to live with those resources, and therefore that has suppressed demand. And therefore what we saw in 2022 is that as more foreign exchange came into the system, and this would have come in, excuse me, basically through the petrochemical companies who tend to put their money into the commercial banking system, and through Heritage, formerly Petrotrin, which also tends to put its foreign exchange earnings into the banking system. The banks, therefore, they got more foreign exchange that they could sell to the public, and they therefore sold more to the public. So we have seen a very sharp increase in sales of foreign exchange, reflecting higher import demand. Obviously, we've seen that there are fewer complaints about people not being able to get foreign exchange in 2022. So the net effect of that is that our foreign exchange reserves essentially remain flat. We know that the HSF has gone down. We don't have any current data on where it is now. The latest data I think that we've seen is probably about June or September. The government has not had to borrow. They did borrow a little bit from CAF, I think recently for WASA, I believe. But essentially, the government has not had any significant borrowing to do because we've had this tremendous inflow of revenue. And therefore, external debt has remained about the same, with GDP rising, or GDP in current prices rising. Okay. Just to make a point, we can look at some of these numbers as the things that we see on the surface. But beneath the iceberg, there are a number of things that we simply don't see very well. One of the most important to my mind is the question of investments. We have not produced national income and product accounts in this country for years. We just simply don't know what is the level of investment taking place in the economy. We don't know where that investment is taking place. We have no target rate of investment. We have no target growth rate for the economy, and therefore we have no target rate of investment, and we have no target rate of investment in the sectors in which we want investment to take place. You see, because people could invest in malls if they want, which, well, they essentially consume foreign exchange, but is that where we want investment to take place? But since we don't know what the targets are, since we don't know where we want investment to go, then quite frankly, it's a case of almost anything goes. Crime and violence, I know that Roger is certainly going to talk about that. That's one of his pet topics. Compensation is an issue which this is one of the beneath the iceberg kinds of factors. The labor market, inflexibility, the fact that we have institutionalized inflexibility in the labor market by the way in which we do industrial negotiations are backdated. We are now negotiating for the public sector wages going back to the triennium beginning in 2011 or 2012 or something like that, which is, quite frankly, it's really ridiculous. Inefficient institutions all around the place, not working properly, and of course our weak infrastructure, right? Which our Calypsonians and so on will talk much about during the course of the season. In respect of the global energy market, I'm not going to spend much time on this. I know Kevin is going to go much more extensively into this. In the short term, difficult to predict what is going to happen because the war is ongoing, and because in the middle of what is happening in the short term, we have, in my view, a structural change that is being initiated in the global energy market that is shifting that market towards the east, towards China, that the Arab countries, the Middle Eastern countries are pivoting their supplies of LNG towards China. China is going to be reducing its consumption of coal quite significantly, increasing its production of renewables, and increasing its consumption of natural gas. And that pivot, and Russia is going to pivot, I think is already beginning to pivot in that direction, does have implications in terms of how the market, I think, unfolds. And then of course we have the climate change factor. So there are two scenarios that I see. One, a fairly optimistic scenario, and I think it is, in fact, in my view, the optimistic scenario is probably, I give it a 65% probability of occurring. In the pessimistic scenario, the Ukraine war continues for all of 2023. It in fact gets worse. The monetary policy remains tight. China economic growth stalls, and we have recession. That's a pessimistic scenario. I don't think it could happen. I don't think that is what is going to happen. I think that the Ukraine war is probably going to end by the summer or the early fall. Why? Because notwithstanding the fact that tanks and missiles are being sent to Ukraine, beneath that, there is activity taking place beneath all of that to end that war, because the war is not serving anybody's interests. NATO is not going to win. Russia is not going to win. Or when I put it this way, Russia is not going to lose. And therefore, a resolution has to come to the war in Ukraine, and it cannot go on indefinitely, notwithstanding what Mr. Zelensky would probably like. I don't think that we are going to have recession in 2023. I think it's going to be averted. We will have a couple more increases in interest rates by the Fed and the Europeans. I think that is going to taper off, and we're going to settle with interest rates. They're going to plateau, and China's economic growth is going to recover. Now, with that, therefore, the projections that I am going to assume is that our natural gas production is going to remain flat in 2023. Because although a lot of activity is happening in the sector, that activity is simply going to offset the natural decline that is taking place in those fields, and we are not going to see any significant increase. So I'm saying 2.8 BCF is what we are going to see in 2023. Natural gas prices, very difficult to predict. As I said, you know, the World Bank is predicting $32 for the European Union and $6.20 for the US. I think that 375 is a good number. The futures market right now is actually below 3. But that's the futures market, and that has to do with all kinds of things with the winter and so on. But I think that the US Henry Hub is probably going to average about 375 for the year. LNG production, 1.4 BCF is what I'm calling, representing about 50% of natural gas production. LNG prices, what is going to be interesting about LNG prices, and I'm sure Kevin will talk a little bit more about this, is that with LNG prices where they are, the net back to Trinidad for selling LNG is likely to be higher than the net back for the petrochemical sector. And that's an interesting situation that we will see how the petrochemicals, how the point leases companies respond to that. Crude oil production, 60,000 barrels a day is not going to get much higher than that. We're struggling now at around 56, 58,000 barrels a day. WTI, I'm calling 85. Morgan Stanley has it at 92.50, which is in fact the budget number. Imported inflation about 3.5%, interest rates 4% for the US 10-year, and ammonia prices are going to revert to the mean, but I think for 2023, we're looking at about an average of about 600, and methanol prices, again, will revert to the mean, but for 2023, we're looking at about 500. So the outlook is for fiscal operations, I'm seeing a small deficit, maybe less than 1% of GDP. The balance of payments, the foreign exchange reserves will again stay flat for 2023, simply because although foreign exchange supply is going to increase, the demand for foreign exchange is that pent-up demand is being released and is going to consume whatever additional foreign exchange comes into the system. Inflation, 6% overall. Food at about 8%, because I'm saying at the back end of the year, inflation is in fact going to taper. And growth will be about, I'm saying 1 to 1.5% for 2023. For 2022, the numbers are what the numbers are, notwithstanding recent media releases. What we've seen in the first half of 2022 was a bounce, the COVID bounce from COVID. But the numbers in respect of once the energy sector is flat, it is unlikely that real GDP is going to be growing by more than 1, maybe 1.5% for 2023. So my summary assessment is that we are going to experience low growth in real GDP in 2023, mainly from the non-energy sector, driven by higher government spending. GDP current prices will grow more strongly, excuse me, because prices are going to be higher. Fiscal operations, a small deficit. The external accounts are going to be in balance. Inflation is going to rise, but the rate of change is going to decelerate in the second half, although the removal of subsidies, if effected, will contribute to higher measured inflation.
Thank you.